Hey everyone, welcome back to the channel, your number one source for income-oriented investing. It's time for another episode in our monthly series where I will go over the entire income-oriented landscape on the US stock market with a special emphasis, if not primary or only emphasis, on covered call ETFs, income-oriented ETFs. So before we start, let's look at what the stock market has done in the last month. So of course, the S&P 500, probably the best indicator of the overall American stock market in the last month, up 1.09% in the last month, so markets are still hitting pretty much all-time highs. I am filming this on December 9th. There is a little bit of a dip today, but in the past month, still positive. Obviously, with Trump's win, the market's at a complete rampage right now. It's just rocketing upwards. Same story with the NDX, with the NASDAQ 100 actually up a little bit more at 1.7% in the last month. And the Russell 2000 index, the small caps, actually down in the last month, in the last 30 days, just a little bit down 1%. But overall, the market, I would say, pretty much at all-time record highs. Even the Russell is pretty much getting there. It's right at the highs of 2022. It almost reached it. So obviously the stock market is doing really, really well. So before we get into the landscape, I'd like to thank the sponsor of this video and good friend of the channel, Curve ETFs. Don't forget that they have a bunch of single stock covered call ETFs. So if you like Amazon and Apple or Google, Microsoft, Tesla or Netflix, but you're an income investor, you could get these. And they write the covered calls for you where you could get some monthly income. They also have a brand new technology ETF, KQQQ. And if you're interested in learning more about these ETFs, how they compare to YieldMax, I actually did a Q&A with Howard, the CEO of Curve, in a recent video a month ago where we discuss all the Curve ETFs, the returns, how they compare to YieldMax, and we also discuss the Curve Technology Titan Select ETF, KQQQ, so you could figure out what that one is all about. I'll put the link to this video in the video description below. All right, so as usual, everyone, we're going to go through all the S&P 500 covered call ETFs first, then the NASDAQ, then the Russell ones, and then the other alternative and more niche covered call ETFs. So of course, we're going to start with the big daddy, right? JEPI. JP Morgan one, right? So this one is not exactly the S&P 500 like I keep telling you, but it is more of a defensive version of the S&P 500. Latest distribution was declared, so you're looking at about an 8% yield right now with this one. The distribution is, you know what, let me just take out my face. There we go. Want to make sure I'm not blocking anything. So latest distribution a bit higher than the last one at 40 cents. So you're looking at about, you know, this one's always about 7 to 9% yield. Right now it's about 8% yield based on the latest distribution. You got its main competitor, I would say, Bali from iShares, which is actually outperforming JEPI by a lot. You could see here, same expense ratio, about the same yield as well. The latest distribution, 23 cents, pretty much their highest one, I believe, yet. But this one, if we look at the 12-month trailing yield, so the average yield, if you add up all the past distributions, you're looking at a little over 7%. But based on the latest distribution, almost 9%. So definitely giving JEPI a run for its money. You guys know I've covered this before. I think Bali is more advantageous or is better than JEPI. Speaking of better than JEPI, GPIX, this is the Goldman Sachs S&P 500. So this is basically JEPI, but the actual S&P 500 index, whereas JEPI is picking stocks. So this one is also doing really well. If we look at, you know, same management fee as well. I think right now it's actually at a discount until the end of the year at 29 basis points, but it is outperforming JEPI. And by the way, we'll see performance. I'm going to introduce something new in this monthly series. Because we have so many ETFs, S&P, NASDAQ, I'm actually going to do some total return comparison. So you'll be able to see the comparison between certain categories of S&P 500, NASDAQ, etc., etc. You'll see that in a second. So latest distribution here, Well, this is October, so they're really behind here. I don't know why they don't update their website, but they're very, very consistent distributions, everyone. You're looking at a similar yield to JEPI and Bali. You see that the 12-month trailing yield is about 7 to 8% here for GPIX. So that's what you're going to expect, about 7 to 9% with these S&P 500 ones. Then, of course, you have one of the favorites, very popular at $2.5 billion, SPY from NEOS, a very, very super consistent 12% annual yield, or about 1% every single month. So this is why people like it. The distributions are very, very consistent. Latest one a little bit higher than the last month. You could see that they're pretty much identical almost all the time. These guys have a good strategy in giving you very, very consistent distributions. And then last but not least, in what I would say the basic category, is IVVW from iShare. So this is from the same people who make Bali, but it's actually the S&P 500, whereas Bali is choosing stocks in the S&P 500. So this is literally the S&P 500 index, 1% out of the money call. So this is a rinse and repeat strategy, everyone. I'm just trying to find it. Here it is. The S&P 500, it follows the index 1% OTM. That stands for out of the money. So yield is pretty high. You're giving up a lot of upside for this one, but you're getting very high yield. Latest one, 43 cents. So if we look at the 12-month trailing yield, we don't have that because it hasn't been out for a year. But if we look at the distribution yield, and I believe this is based on the last distribution, you're looking at about 10% yield on this one. This one, what I feel is the strongest thing about this one here, IVVW, is that it's a rinse and repeat. You know exactly what they're doing every single month, and it has the lowest fee. It's the lowest fee S&P 500 covered call ETF at 25 basis points. So I would say these are really the 5 basic ones, right? There's no daily options here. This is just your classic covered call ETF. So if we do a comparison, a total return comparison of these 5 ETFs, so right now the winner in the last 3 months is this one here. It's GPIX. So it's the Goldman Sachs one. You could see that it's beating actually a little bit Bali and JEPI as well. IVVW 5.73. If we look at 1 year, so these 4 have been out for 1 year. IVVW has not been out for 1 year. That's why it's not here. But in 1 year, the winner is Bali and GPIX. They are strongly outperforming JEPI. You guys know that, this is expected. I keep saying JEPI is always going to underperform, or Bali is going to, GPIX and Bali is going to beat JEPI, because JEPI is not the entire S&P 500. It's defensive. So there's less NVIDIA, there's less Tesla, so there's going to be less return there. But you see that Bali is actually number 1 right now in 1 year, but GPIX is really, really close, and SPY not bad either at about 25% annual return. This is with the dividends, right? This is return. Moving on, you have, don't forget, there's if you want an equal weight S&P 500 for some reason, Invesco has one, RSPA. You're looking at a yield of about 9%. So the latest one's a little bit higher. So if for some reason you don't want market cap weighted, you want more of an equal weighted playing field, equal weighted portfolio, this one is interesting as well. It is a covered call one as well, but it's equal weight index. Personally, I would always go with the market cap weighted, but whatever. Next, we're going to look at the daily options S&P 500 ETF. So S&P 500 covered call ETFs that use daily options, everyone. You have the original one here, WDTE, used to be called JEPY. These ones are doing weekly distributions now. You have the latest one here at 20 cents. Of course, it's going to vary greatly based on volatility. We know that volatility, or the VIX, is really, really low right now. So you're looking at approximate yield of 25%. You have SPY-T, which I prefer more. If you added the Defiance ones, I like SPY-T much, much better. It's you're gaining a lot more upside. They actually just hold IVV rather, and they do a daily call spread. So this one is actually, we'll see in a second, outperforming this one by a long shot. And what's cool about SPY-T is that they have a annual target of 20% yield annually. So this is why you will see very, very consistent monthly distributions. You have XTTE from Roundhill. This one does weekly distributions. Very, very popular, gaining a lot of popularity. Performance is really good. Latest weekly distribution here, 23 cents. But again, they're going to vary based on volatility. Volatility is pretty low right now. And of course, you have the lowest fee daily options covered call ETF from ProShares. It's iSpy, also doing pretty well here, as we'll see in a second. Lowest fee daily option covered call S&P 500 covered call ETF at 55 basis points. All the other ones are higher. And let's check out the latest distribution here at, it's 29 cents, 30 cents. So you could see, the distributions are going to vary tremendously here. I think this one, the yield is probably close to the not 8 to 10% yield range. You could always calculate it yourself here. Do they have, here it is. It's 9.49 annual since inception. Okay, this is probably, I'm assuming this is based on the average of all the past distributions. So good for them for adding it there. And last but not least, T-Spy, which is actually having phenomenal return. This is the newest one. So this uses daily options on the SPY. It's very, very interesting. So if we actually compare all 5 of the daily option covered call ETFs, they all have been out at least 3 months, and we see that the winner is still the round hill one, XDT. So again, guys, this is performance. This is total return here. Not the yield, performance, total return, what it's really all about. So you see XDT is still the winner, but T-Spy is really, really there next to it. Very, very impressive. And iSpy is next after that. So the daily ones doing the best are really these ones right now. And, as time goes on, we'll be able to see the year to date, the 1 year. So what do you guys think, by the way, of me showing you the performance? We have so many now. So what I've decided to do is for the S&P 500 basic ones, which is these 5, I'm going to show them to you together. And then for the daily option ones, I'm going to show you them together as well. So right now, the round hill is the big winner with T-Spy right there. So very curious to see going forward. Moving on now, everyone, to the NASDAQ 100 cover call ETFs. Of course, you have the OG QILD here, which you guys know I am no longer a fan of because of the strategy. There's much better strategies out there, but still chugging along. This is a rinse and repeat strategy, of course, everyone. Not going to get into it anymore, but they basically they do at the money calls. They give up the entire upside of the whole NASDAQ 100. So they do at the money calls on the whole portfolio, and they give you only a maximum of 1% of the premium that they get every month, and the rest gets automatically reinvested in the fund. You have JEPQ, which is much better than JEPI in my opinion. Much, much better. Focuses more on the NASDAQ 100, but again, just like JEPI, it's not the entire NASDAQ 100. Just like JEPI is not the entire S&P 500. It's a little bit more defensive, but it's much, much closer to the NASDAQ 100, and JEPI is compared to towards the S&P 500. Latest distribution, 50 cents here. Looking at a yield, maybe 2 or 3% yield higher than JEPI typically, everyone. So you're at 11 here right now. Moving on to the what I think is JEPQ's biggest competitor, GPIC, which is the same thing as GPIX. Same strategy, same management fee and everything, but it's on the NASDAQ 100. So this one, again, similar. It's going to have similar yield to JEPQ. It does have one advantage. It does have very consistent monthly distributions versus JEPQ. They're a little bit more all over the place. The last one here shown, the October one, is 41 cents. So you could see that they're pretty consistent. And if we look at the 12-month trailing yield, which just means the average in the last year, you're looking at just under 10% here. QQQI, of course, much higher yield at 14% yield. Same strategy as SPY-I, but on the NASDAQ 100. Again, very, very popular, very consistent monthly distributions. Also growing rapidly, just past, getting to that 700 million mark. I'm sure it's going to hit $1 billion within the next year for sure. And you also have the creator and manager of the NASDAQ 100 index, or the guys who manage QQQ, Invesco. They came out with their own. Makes sense. QQQA. So QQQA is the NASDAQ 100 with covered call ETFs. Sorry, with covered calls. What am I talking about? Covered call ETFs. NASDAQ 100 with covered calls, and you're looking at a yield of about 10-11%. So, all of these JEPQ, GPIC, QQA, I would consider them more basic options, and you're all looking at very similar yields between 9 and 11. QQQI much higher at 14. So if we compare all these basic ones, QYLD versus JEPQ, GPIC, QQQI, and QQA, what I feel are the basic or classic NASDAQ 100 covered call ETFs. Which one is winning? Well, right now, believe it or not, in the last 3 months, it's JEPQ. JEPQ is doing really well here. Even if we look at year to date, it's also beating GPIC. So these two are definitely in competition to each other. They're very, very, very close. And JEPQ is beating GPIC a little bit. So, this is why I keep saying JEPQ is much, much better than JEPI, right? It's much closer to GPIC's performance versus, JEPI versus GPIC's with an X. But QQQI is doing pretty good too. Even QQA, you see, they haven't been out for that long, so we don't have year to date or 1 year. But we have the 3 months, and you see that it's, they're pretty much in line. They're pretty close. With, of course, QYLD in dead last place, horrible in the last 3 months. You could see the 1 year, 20 versus 28 and 27. So this is of course because QYLD gives up all the upside, so it's not gaining all the upside that the NASDAQ has given us in the last year or 3 months. They give up a lot of the upside. So I feel the strategy is not superior. I think the strategy of the other ones are much better than QYLD. So let me know what you think. You think this is useful, by the way, to do these total returns? If it is, let me know, guys. Give me a thumbs up also in the video. I would really appreciate it because I'm going to keep doing it. Last but not least, for the NASDAQ 100, it's the daily ones. So you have the original one at QQQY, which is now on weekly distributions, 35% yield right now based on the last weekly distribution here. You have QQQT, which is the same thing that SPY-T does, same strategy. They hold QQQ, and then they do a daily call spread. Also a 20% annual yield target. So you're going to have very consistent monthly distributions, with the latest one being the highest one it's been, 34 cents. Then you have, of course, my personal favorite, the one that I own, QDTE, which is XDTE's NASDAQ brother. Just past the 600 million mark, doing really well. We'll see the performance in a second. Last weekly distribution, they've been around 22 to 25 cents lately. I'm surprised, actually. I thought they would go much lower because volatility is almost non-existent. I thought it would be more like 15 cents or something like that, 10 cents, 11 cents. But hey, they're still managing to give a pretty healthy weekly distribution. And then you have the ProShares one, IQQQ, which I believe is the newest one out of the bunch. The lowest fee daily option NASDAQ covered call ETF at 55 basis points. You're looking at a yield at about 10, just like iSpy. Lowest fee but big varying distributions, right? Distributions could vary monthly. So if we compare the daily ones now together, QQQY versus QQQT versus QDT, IQQQ, you could see that, a lot of them have, none of them have really been out for 1 year except QQQY. So we only have 3 months to really compare. And QDT is the clear winner, right? Clear winner in the last 3 months. Total performance 9.59, beating IQQ, beating the iShares one, which does a very similar strategy, but it has a lower fee. So I'm still very impressed with Roundhill, guys. Super impressive. You see that it's even beating the S&P 500 in the last 3 months. And second place, you have the ProShares one, with QQQY in dead last place. So that's it for the NASDAQ 100. Let's continue on now to the Russell 2000 ETFs. All right, Russell 2000 covered call ETFs. We got 4 of them, I believe. 1, 2, 3, 4, 5. Sorry, 5 of them. So you have what I would like to call the basic one, IWMW. This is the lowest fee Russell 2000 covered call ETF. Rinse and repeat strategy, just like IVVW. Same exact thing as IVVW, except it's 2% out of the money. You're looking at a yield of about 16%. So this is pretty high yield. The Russell is much more volatile than the S&P 500, but varying monthly distributions. If you want more consistent distributions, again, that's Neos' specialty, right? They got IWMI. This is the Neos one, about 14.5% annual yield with very consistent monthly distributions. You have the daily option one from Defiance, IWMY, highest yielding one, I believe. They don't have a T version, a 20% annual version. I guess it's not popular enough for them to come out with it yet. And then, of course, there's RDTE from Brownhill. This does daily options as well. A very high yield, latest distribution, weekly distribution, 28 cents, a little bit lower than the last week, but again, based on volatility. And then ProShares has their own too. So ProShares, Roundhill, they all have their own S&P, NASDAQ, and Russell 2000. Of course, this is going to be the lowest fee. Daily option cover call ETF, not the lowest fee in general, but the lowest fee daily option one. The lowest fee is going to be the iShares one. And if we look at the latest distribution, this is brand new, only 2 distributions here, 56 cents, a little bit lower than the last one. Do they actually have a yield somewhere here? 12% yield approximately here for this one. So I'm not going to do a comparison with these 5 because a lot of them have, excuse me, a lot of them have not even been out for 3 months. So there's not much comparison data. So hopefully next month, I'm going to wait till all of them have been out for at least 3 months. It's probably next month, and we'll do a comparison. Moving on to the alternative and everything else, niche, alternative, everything else. You got YMAX, which is doing really, really well ever since YieldMax changed the strategy, introducing call spreads to all their YieldMax ETFs. I'm really starting to see a difference. If you compare YMAX, for example, to XDT or QDT, you see that you're seeing the total return catching up significantly. Sorry about that, guys. I should have had this ready. But check out YMAX versus QDTE, guys. YMAX is now outperforming QDTE. My opinion why? Definitely that introduction of the call spread strategy. Look where it started, it's right near the end here. Also, YMAX does have a lot of exposure to crypto and Bitcoin, right? It has the MicroStrategy, it's in there. It has the Coinbase, it has the actual Bitcoin ETF in there. It has Square, it has, or Block, sorry, Tesla. So a lot more concentrated in companies that have benefited from Bitcoin skyrocketing. And you see that now it's actually outperforming QDTE. So I feel like YMAX is by far the best YieldMax ETF. Weekly distributions, pure diversification. So definitely one you could consider as a core position. And when I update my grade 11 video next year, YMAX is definitely going to be in it. So we'll have to probably do a grade 12. SVOL, for, in my opinion, if you want a little bit of fixed income, if you want low volatility and safety, it's going to be the best one. Much better than owning fixed income ones like TLTW, etc., etc., etc. I have to commend these guys to keep changing it up and keep changing the SVOL to make it better and better. I've noticed now that they actually hold a bunch of S&P 500. So it seems like they're reducing a little bit their short-dated government bonds exposure, and they're adding more and more S&P 500. If it was up to me, I would just do the VIX strategy that they're doing and then just have nothing but the S&P 500 and just do puts and call spreads on the S&P 500, which you could see here. They're doing that here. And they're greatly reducing their short-term government bonds because when interest rates going down, it brings in less money. And unfortunately, this is why they had to reduce the dividend. They reduced it again at 27 cents. But hey, still about 15-16% yield. In my opinion, this is the best ETF if you want some lower risk, more stable fixed income in here, but you're still getting very high yield. Moving on to the niche funds, everyone. You got quite a few that are good now from Rex Shares. You have FEPI for your technology, your general technology stocks. You're looking at about 25% yield. Not much has changed with this one. The monthly distributions are very, very consistent. They've been going just down a little bit. It's normal. Volatility is down. They have the same thing, but more AI type stocks. This one, the yield is a little bit higher because you got more volatile stocks in here, like Palantir and ARM and CrowdStrike, et cetera, et cetera. So really cool way. If you're an income investor, you want to invest in AI stocks, AIPI is definitely the way to go. And they even have a new one called SEPI now, which focuses on crypto. So this is a fantastic way if you want to get into invest in crypto indirectly, not directly, in Bitcoin, for example, because you're going to be investing in companies that are related or will benefit from the rise of crypto and Bitcoin. So you see the biggest two positions, Coinbase and MicroStrategy, right? Makes sense. But you also have Tesla. You also have miners as well, right? People who mine Bitcoin, PayPal. I think like Visa is in here as well. Robinhood, right? So everyone, this is a cool way if you want to, dip your toes in Bitcoin and cryptocurrency, but you don't believe in it yet. SEPI is a good way to do it. They didn't announce their first distribution, but my guess is that it's going to be pretty high. It's going to be close to AIPI's distribution rate of about 30-35% because these stocks are pretty volatile. Then you have the classic Bitcoin cover call ETFs, YBTC from Roundhill, which just write cover calls on BITO. The BITO ETF last monthly distribution was much higher than the last one, of course. BTCI, which I have a video coming up really soon, which has even higher yield, I believe. Well, actually, this is 40. This is going to be, I'm guessing it's going to be like SPY-I and QQQI. It's going to be a little bit more consistent with the distributions. The strategy is actually the same as YBTC. They're writing covered calls on BITO. You see them right here. But again, if you're interested in BTCI, watch my NEOS Q&A video where I talk about BTCI in detail with Troy. You're looking at a very high distribution rate. Again, another way to invest in Bitcoin if you want a little bit lower volatility because of those covered calls. You still have Maxi, which is from Simplify, which is doing call spreads to add a little bit of income, but they're not doing the covered calls, or they're not limiting the upside of the Bitcoin. You actually see all the spreads here. They do it on everything: MicroStrategy, IBIT, gold, the Russell 2000. You see the Russell 2000, the Nasdaq 100, the S&P 500, and then they even own some short-dated government bonds. And latest distribution, $2 instead of their normal $1. So I'm assuming that's because if you remember last year, the last dividend of the year was a massive $4. So I think they're, because ETFs have to give out all their capital gains. So this is probably why they've increased it. So I'm assuming that the last distribution is going to be pretty big as well. We'll have to see. But if you compare all of them, maybe I should do the comparison. So yeah, I'm going to start doing the comparison with these three, mine as well. Versus Bitcoin itself, versus IBIT, but BTCI has not been out for 3 months yet. So once they've all been out for at least 3 months, so we're waiting for BTCI, I'll actually do the comparison, the total return comparison. Last but not least, you have Clip. If ever you want to get into Chinese tech stock companies, this does at the money covered calls on their KWeb ETF, so you're giving up all the upside. And it's done okay. I mean, the distributions are obviously going to go down over time because even though lately they've been a bit higher because volatility has been higher, you see I love how they put the monthly distribution percentage. You could see the volatility going up in the last few months. But yeah, I mean, I'm not personally a fan too much of China, but if you want to invest in Chinese tech stocks and if you're actually skeptical, Clip is actually a good way to do it because they're giving up all the upside to give you maximum premium. And last but not least, I'm not going to go over the fixed income and closed-end funds anymore. I think they're obsolete versus covered call ETFs. That's just my opinion. But if ever you want to get into closed-end funds, the best ETF, the best option, in my opinion, is CEFS. You get this ETF and you're getting a bunch of closed-end funds, right, all over the American market. You see the list here. And these guys, Saba, know exactly what they're doing to capitalize on the discounts. and the returns speak for themselves. This is by far one of the highest return all-in-one closed-end fund solution. So that's it for this month, everyone. We're gonna do the same thing next month. So thanks so much for watching. I really appreciate it, and see you next time.